SaaS Backwards is sponsored by Austin Lawrence Group, specializing in demand gen for SaaS. It sure is noisy. I deleted 100 emails from vendors just this morning. Your buyer has gotten better at ignoring you, and you're gonna need a big idea if you want to cut through all that clutter. Austin Lawrence is just the right agency to help you find it. So if your campaigns are falling on deaf eyeballs, let's talk. Visit austinlawrence.com today and let's build something bigger.
Welcome to the SaaS Backwards podcast, where we reverse engineer the success of fast-growing SaaS firms and explore strategies CMOs and CEOs are using to drive their businesses forward.
Welcome to SaaS Backwards, a podcast that helps SaaS CMOs and CEOs to accelerate growth and enhance profitability. Our guest today is Jason Shapiro, CEO and founder of 82i, a strategic growth services firm providing advisory and execution in areas with which founders consistently find themselves struggling. You could describe it as a dynamic, cross-functional co-founder for hire. Hey, Jason, welcome to the podcast.
Thanks for having me, Ken. I'm really looking forward to the conversation. Longtime fan of the podcast and looking forward to the discussion.
Thanks so much. Hey, before we get started, could you tell me a little bit about your background and your company?
Definitely. So I started my career as a teacher and then spent about a decade as an investor. And 82i really brings those two experiences together because when I was investing, one of the things that I saw commonly with founders is the same sort of mistakes, misconceptions, sub-optimizations of what they could and should be doing with their business and with their capital raise process. And so I set out to find a solution for that and came up with 82i as a result. And so 82i is a business that our mission is to make entrepreneurship easier for founders, their teams, and their investors. Entrepreneurship is something that we're incredibly passionate about and really motivated by. It's such a phenomenal and fun and grueling process that requires folks to be strong in a number of different areas. And that is just an interesting thing to watch, observe, and support. And as I said, super hard. And so we wanted to come up with something that could make it a little bit easier for folks as they go from 0 to 10 or 20 and beyond. And that's how we came up with 82i.
Nice. You know, it is starting a company and generating real revenues is just incredibly difficult. And, you know, I have profound respect for any entrepreneur in almost any business. In fact, even like the hot dog vendor, it's like, if you can get a buck out of my hand, you must be doing something right. And, you know, more seriously, to be able to grow a business, support families, you know, and create something of value, incredibly difficult. Let's dig right into it. I think it's worth examining what you guys mean by co-founder for hire. And, you know, like, why would someone need that service? We're familiar with like fractional CEO, fractional CFO, but this is a new idea, this co-founder. Let's dig into that and what you mean by it.
Yeah, absolutely. So we came up with this about a year into our journey. We're 2 years old, and we started with the biggest pain point that we commonly see with founders, which is raising capital. It's a tough, you know, you have to do something and go up against folks that do it all day, every day for a living. There's very unclear and vague rules and advice on how to do it best and so forth. So we came up with this process to help founders in that. And what we found was after we helped them with a capital raise, they often wanted us to stick around and help them solve the next problem and the next problem and the next problem. In one light, entrepreneurship is effectively just problem solving day after day, minute after minute, hour after hour. There's always a new problem to solve, and good founders are able to do that in really creative ways that are efficient, effective, and get the job done. And so over time, what we found was in our niche, we focus on companies that are anywhere from about 1 million in revenue or ARR up to 20. And in that area, founders need a full management team, but they're not able to afford one yet. In order to get a full management team, you need, you know, 5 to 8 C-suite executives with XYZ experience, and those can run anywhere from 200 to 500K a year. And when your business is 5 million in revenue, you just can't afford it. And so what ends up happening is that founders end up wearing all these different hats. It doesn't matter what day of the week it is, they're probably going to do an hour as a CMO, an hour as a CFO, an hour as a hiring officer, whatever it is, there's a million different things they have to do. And so rather than trying to hire each of those people, we came up with this term co-founder for hire, because co-founders are folks that can get in there with you, serve cross-functionally, and have your best interest at heart. But if you didn't start with a co-founder, it's hard to find one. And even if you did start with a co-founder, those are hard relationships to start and maintain. And so we come in, and the way that we do it is with a no commitment hourly price. So it's always cancelable, and the onus is always on us to prove our value and so forth. And so it creates that co-founder for hire relationship where we'll come in, learn the business quickly, be able to engage in a variety of different functions, take some of those hats off our founders' heads, and enable them to get to that point where they can hire the full management team once they get to 10 or 20 or wherever in revenue.
Yeah, it's really interesting. My experience today running a small business, between two meetings, I had 5 minutes to make an offer to a new employee. And it's probably a function that deserved a little more attention than that, though I think it'll work out fine. It would just be great, as a founder to be able to say, hey, I'll let you focus on talent acquisition as we grow, so that I can focus on leading sales, leading marketing, that kind of thing.
Exactly. And that's where founders should be spending their time at this stage. I think we can commonly see founders that spend too much time raising capital, or spend too much time in product, or spend too much time internally, or whatever it is. And, there's nothing like revenue when you're a $3 million business. And as much as possible, founders should be spending 90% of their time there if they can. And they just can't, because they get distracted and pulled away into things that matter. You do need to send that offer letter out. You do need to fix the tech issue that's preventing your team from being able to communicate. But really what you should be doing is revenue. And so if you can find someone that you trust, or that you learn to trust because they earn it, then it's a great solution.
Yeah, I mean, it's interesting, the focus on revenue. Not every founder's a salesperson. I mean, I don't believe salespeople are born. I think they're made. But still plenty of founders aren't comfortable in a sales role. But that might be something that they can afford to hire, but all these other functions may not, especially in the smaller part of the range of the companies that you service.
Yeah, that's a really good point. I mean, if it's a founder who has created a product and who is sort of product oriented, as a counter example, like, yes, they should go hire that sales leader. That is the hire that they should make. And then all of their time and energy should go into the thing that is their best and highest use. That is another advantage that we see with some of our founders, is we just sort of take things off their plate and let them focus where they're going to be best. But I guess the point that I was attempting to make is that there should always be some amount of focus on revenue, and it should be one of the first things that you found a way to solve, because at this stage, the better you can do that, it just solves so many other problems that come.
Oh yeah, and also the product visionary is really important in closing those initial deals, right? You have to wheel out the CEO founder to close those important early deals, even if they're not going to be beating the bushes to tee up the opportunities. So absolutely. Hey, you've mentioned raising capital, and that's a big part of what you help founders do. And I love some of the ways you've presented, the issues surrounding raising capital. And why don't we dig in on what you've called the common misperceptions about raising funds for a young company? I think that a lot of the people we have listening to the podcast are in that early stage. So this is very relevant to them as they seek to grow through investment.
Yeah, absolutely. It's a scary thing, and can be a scary thing for founders, because it's not something that they should know how to do. And it's not always something that they do know how to do. What founders are good at is running their business, building their product, knowing their customers. And the raising capital and deal game is a completely different game that maybe they've done once or twice, but shouldn't be experts at it. They should be experts at their business. And so we see all kinds of misconceptions with this. And this is something that originally got me the idea of founding 82i, because in talking to hundreds of founders who were trying to raise capital, I kept seeing the same mistakes happen again and again. And I think you can kind of zoom out for a second and just think of, like, what do people do when they're trying to do something that is new to them? How do people commonly react to that? Well, some people, they get overly into it, consumed, almost aggressive about sort of learning it. Other people shy away. They're nervous. They say, I can't do this. I don't know how to do this. And I want to find someone to help me do it. I think both ends of that spectrum are probably the incorrect approach. On the second hand there, anyone can learn this. It doesn't matter if you're salesy, it doesn't matter if you're, know the investor landscape. I think one of the things that we try to coach folks on is that this is a very learnable skill. And it's only up to a particular level, which is the business that you're selling and the business that you're leading investable. The single best way to become good at raising capital is to have a good business. And one of the common mistakes that we see all the time is founders that think they can sort of sell their way into an investment or think that there's tricks of the trade or shortcuts around it. And we see folks spending, I talked to a founder last week that had 420 investor calls to try and find investment. And if you take all of that time, 420 times these 30-minute phone calls or whatever they are, that could have gone into building the business, growing revenue like we spoke about. And then that probably would have raised them capital versus that time spent there. And so those are a handful of the misconceptions that we see, but it starts with having a good business.
Yeah. So the investable business, I think that's worth unpacking a little bit. There's got to be 8 or 10 categories of effective operation in a business that lead to investability, right? So I think it might be good for you to sort of take the top few things that you see as, especially in these young companies, where they're likely to need to develop, a more robust business, the internals of the business. Just to give you one example, I've had a client where they've been trying to get investment for some time, probably that same kind of hundreds of hours wasted, and they don't have pricing discipline and their contracts are all over the place. So as you go through due diligence and you look at the average selling price is a number, but if you look at the actual contracts, it's a dog's breakfast of contracts. So I'm sure that scares off a fair amount of the people who might invest in this business. But let's get your take on what those, like the key factors of investability.
Yeah, it's one of those where it's an art, not a science, and it's often an amalgamation of things that happen. But the top things that I see first is just growth, revenue growth, year over year percentage. The higher that is, the better. Investors, especially at sort of our level, 1 to 10 million roughly, greater than 50% is good, greater than 100% is great. Those are the numbers they're looking for. I think where people struggle on the capital raise front and really can't cross that threshold of investability is less than 10% or flat growth or negative growth. It's sort of rare to see companies like that at this stage because it takes just a little bit to get that growth, but it happens. And when you're in that seat, the time that you could spend trying to raise capital is probably far better spent, like I said, sort of focusing on revenue growth. That said, there are investors that are popping up that are focusing on those types of companies, particularly when they have high retention, which is sort of the second metric and barometer that we look at. Investors want retention. If they know they can invest in a business that has $5 million of ARR and it's going to retain at 95%, that means they're going to have $4.5 million to start next year, and they only need 500K of new sales in order to be flat and likely grow. And so if they have that stable, revenue basis, it's a highly investable asset because the investors will know that it's, generally going to continue, and it removes a lot of risk. The other one is profitability, and this is correlated with growth. To the extent that you are growing north of 100%, you get some leeway to burn and to spend cash because you're trying to gobble up market share. But if you're growing at 10% and burning a bunch, then that wouldn't generally look good to an investor. And so growth and retention and profitability, I think, are the 3 big ones. Once you cross that mark, you start to get into all the nuances of market and competition and internal operations and so forth, and to kind of paint this picture of the broader situation.
Well, and that's sort of like the core of especially, the focus on software companies, right? This is that core thing. Are you growing? Are you retaining? And are you profitable? That's like, are you a good operator? Are you a good seller? And do you take care of the people who commit to you? So pretty much you have to be a decent operator to be investable is what you're saying.
I wouldn't say that. I've seen absolutely horrible operators that were investable because the fundamentals of their business were so strong. When you have financial metrics that work and look good, in a lot of cases, it may not matter how good of an operator you are because investors can look at that and say, hey, there's good financial there. We need to do some work with the management team and the operations, but that's something that's fixable. It's kind of the old adage of, do you want to buy the best house on the worst street or the worst house on the best street. And investors have different ways of thinking about that. And both are fine and both are investable. They carry different valuations, which has, knock-on effects on dilution and so forth. But, it really comes down to the financials as at least the first pass.
That's an interesting point because some investors like to be hands-on, right? That's one of the things they think makes their money greener is their ability to help operators get smarter, right? Bring their own resources.
The more they can find low-hanging fruit to further increase and improve the financials, the better. And the more that they see in the financials that they are stable and likely to continue, the better. As an example, we're working with a company and this founder had gone out to market for a few months. Their metrics were sort of just all over the place. They weren't clearly defined and they weren't clearly articulated. And so a lot of investors look at that, and because the first thing they're trying to see to better understand the business, they want to get to know quickly if they can, because then they can talk to 10 other founders and find someone who's better. So the first thing they look at is the financials. In this case, the financials did not look great because the data didn't really look great. But really, when I talked to this founder, what we sort of figured out is like, no, actually, this founder's intuition is right, and the fundamentals of this business are strong. Their customers retain. They have a clear path to growth. They have existing customers that could logically expand, and in a lot of cases had agreed to logically expand. And this founder just wasn't saying that to the investors. And so they didn't know. And he got a bunch of passes. And after about a month and a half, we cleaned up the numbers. We did some coaching. And now we're just about to go out and talk to investors. And I think it's going to have a better outcome because he's maximizing his odds relative to that investability level. And we think it'll help.
I sort of want to segue into another thing that you've done some thought leadership on about setting expectations. And, you also had like an interesting chart with sort of the posture, like the behavior of founders. And just wondering if you can kind of verbally describe this visual, because I thought it was a really interesting kind of 4-quadrant chart. So if you that'd be fun.
Absolutely. Yeah. It is easier to describe visually, but I think I can do it verbally here. So we do this presentation with founders where we compare raising capital to dating. It's actually a pretty apt analogy, and it illustrates some key points that we think are helpful. So in dating, as everybody knows, sort of the more attractive you are, the more likely it is you're going to find a partner. Oversimplifying and not getting into any of the details, at a high level, the more attractive you are, more likely it is that you'll be able to find a partner. In the same way, as a business, the more attractive your financials are and the more attractive your business is, the more likely it will be that you will raise capital. And that's our x-axis. On the left, how attractive are you? Not very. On the right, you're very attractive, either as a partner or an investor. Our y-axis is how confident you are. So we've all probably heard of or seen jokes in movies of those folks that they're not very attractive, but they're super confident. And, they try to go on dates and it doesn't really work out for them. They scare a lot of people off and they're not super successful. And the same thing happens with founders. There's plenty of founders out there who think that their business is beautiful and perfect, as they should. They work hard on it, and we'll all give empathy to founders. But it is a turnoff to investors when the business isn't that great and the founder is overconfident. And it's a quick way to sort of scare some people off. In the same way, we see founders all the time that have very attractive businesses, but they lack the correlating confidence to support it. And so they talk to investors, and investors love that because they sense an opportunity. They can get a business potentially at a better valuation because the founder doesn't really know what they're worth. And so ultimately, the takeaway is that whenever a founder is raising capital, they really need to know what they're worth in the eyes of an investor so that they can kind of match that confidence with that quality of the business. And underlying all of that, like I said before, is to always really know how attractive that business is.
Yeah, it makes a lot of sense. It is a good analogy. And I think, you guys take that a little further in your writings about, what are the areas of attractiveness, right? And this goes back to the investability almost, right? It's, are you growing? Are you retaining? Like all these different metrics. And I think that's where the analogy really does hold up. I found myself single about 6 years ago. And, the most important thing to me was finding a healthy relationship to be in. And I think there's corresponding stuff that investors are looking for. And I think you talked about that in some of your writing about, if you've hit the 3 or 4 hot buttons of a VC firm, it almost 100% guarantee you're going to get a meeting with them if they're actively investing, right? If they're seeking to make investments.
Yeah, that's exactly right. We see founders all the time talk about, I don't have the right network, or I don't know the right folks, and I need help getting in front of the right people. These funds have raised billions of dollars to make investments into companies that, are startups, have founders look like, that founder. And they've invested a lot of that money into finding those companies. And so a lot of these VCs and growth equity firms, they have groups of 5 to 10 analysts whose entire job is to scour the internet and identify as many companies as they can and talk to as many as they can to understand where the good ones are that fit their scope. And, in certain cases, they will find good businesses that don't fit their scope. And I think one thing that founders should know and should be very aware of is to really only talk to investors that fit what you are financially. As I mentioned earlier, a lot of folks think that there's wiggle room, or if they talk to them, they can convince them. They're almost like, it's not a legal mandate, but they're almost mandated to just do the stuff that they've told their investors that they're going to do. And so it's not a good use of time to talk to folks that aren't in the right scope. Yeah, it's a good point.
Yeah, I think basically the point was you can knock on doors if they're likely to invest in your kind of business. And the other side of that coin is don't waste your time. If you're a healthcare tech firm, don't waste your time if the fund you might want to call on specifically doesn't invest in the space, right? Don't even bother.
Yeah, no, that's it. And it's part of the reason that I was drawn to joining in and being an entrepreneur myself.
All right. Well, we did talk in our prep session about, you might not be investable, but you can still find funding. So that seems like inconsistent, like intellectually inconsistent statement. So if we're not investable, how can we get funding?
I think it's sort of be creative and think about funding in different ways. There's other sources of funding than venture. For one, debt. There's all kinds of interesting debt options out there. Venture debt industry, despite some of the recent issues with the banking crisis, is still strong and still making investments. And we recommend that all of our clients go get venture debt because it's an affordable source of capital. Interest rates are rising, but not to the point where it doesn't make sense. And so debt is one, and then capital can also come from the business itself. Like I said earlier, find revenue. Revenue is capital. Cut costs. That also gets you some capital. And so, if getting the capital is the goal, it's just important to think creatively and broadly about getting that. And if you're not investable today, don't spend time on it. Go spend time on those other things and do everything you can to make it investable. That's one of the fun aspects of entrepreneurship, is finding those creative solutions to problems with the constraints that you have. And also remember that investability is only true at a particular point in time. I've seen plenty of businesses that are not investable 1 month, and 3 months later, something happens, they win a contract, some things change, and then they are. As one example that sort of touches on the current macro environment, we have a client that tried to do a deal a year ago, and this was a smaller SaaS business with very strong retention and okay growth, 20%, call it, sort of the benchmark or barometer of whether you're growing or not. And they didn't get the valuations they want. They did get offers, but they didn't like them. 12 months later, the macro economy is worse. As everybody knows, there's still a lot of capital, but VCs are being more selective. Things are more challenging on the growth front. And as a result of that, investors are placing a premium on high retention because in this uncertain environment, where can we put our money? Let's put it into a business that we feel good about it, at least being able to stick with us. And so a year later, they raised again, they got the valuation they want, really hadn't grown enough to warrant that increase, but they got it, and now they're going to do the deal. So things change every day, and investability is only true at a particular point in time.
Interesting. You touched on this point, but I think we should, maybe dig just a bit on, is there venture money out there? There's a lot of mainstream media, general circulation, business press saying, venture is pulling back. And there's some data, there is good data to support that, but venture capital firms are still investing money, right?
Oh, yeah. Yeah, they're definitely investing money, and they need to invest money. As a reminder for how their business models work, they collect money from investors, and it's called their LPs, and they say to the LP, okay, I'm going to invest this over the next 3 to 4 years. And they can sit on the sidelines for a year to be cautious. And that could be true this year. Many are, because it is sort of an uncertain time. But they can't do that forever. And next year they're going to need to, invest, and the year after they're going to have to make up for it. And that said, their whole business is to invest. Like, that is the only thing that they do. And so they're always looking. They may say that they're being more selective, and they likely are. But if they find the right business that makes sense in the environment, they will invest. And so what does that mean for founders? You kind of have to align yourself to what you're hearing and what the market environment says. Is this year a good year to try to burn a bunch of cash and hit a big growth rate to raise? No, I think investors are not going to be as interested in that because it's a riskier strategy. But if it's feasible for you, is this year the year to pull back your spending on R&D and become more efficient in sales so that you can be profitable and still grow at a reasonable rate? Yeah, that could make a lot of sense, and it could raise you good capital. And one thing that we're thinking a lot about at 82i, and we're telling our clients, is there's a phenomenal opportunity right now to increase your efficiencies in a significant way, and that's generative AI. We're using that in every function of our business. We're coaching our clients on how to use that in theirs. It takes a little bit of working with it, but it can really save efficiencies, save costs, and enable you to still sort of be just as effective as you would have been with increased spend.
Makes a lot of sense. Hey, a couple more topics and then we'll wrap it up. One of the things that a founder has to do in order to grow is to learn to let go. Even to work with an advisor like 82i and you and your team, you have to be able to let go. Where should founders start? Like, what are the first things that a founder should start building a team around themselves?
I think it depends on the founder, sort of to our earlier point, like where are they best and where do they need support? I think sort of to your first point, some founders don't let go. And I think, if you're one of those founders, you probably know it. And speaking to that founder, like if you're not letting go and if you're not recruiting a team and giving them ownership in order to do the things that need to get done, like I don't think you can call yourself a good founder, because that is critical to growing. In every business, you will reach a point where you literally cannot do it all anymore. And, if you reach that point and you have to kind of change up shop and change how you're doing everything and change up your team, it could be more challenging for you. And so I think it's important to try and do it early and often, obviously subject to the constraints of your resources and your cash and what needs to get done. I think few examples I see from founders. I have 2 folks on our roster right now that still want to drive the financial model. I don't think that's a good use of a founder's time. That's something that is very outsourceable, very delegatable. And all you really need as a founder in your finance function at the early stages is to be able to plan cash. But you need to plan cash very well, and you need to have it accurately. We've also seen founders that don't have it. They miss their cash forecast by 40, 50%, and that can create a disaster. And so you need to make sure it's done, but it's not your skill set. It shouldn't be your skill set. And there's so many other areas that you can be spending time on. That's one that I would start with. And then, like I said, I think to our earlier points, it's kind of either revenue, sales, or product. Those are the 2 things that matter. Are you building something or are you selling it? It needs to be about that, getting something into the hands of your customers.
Yeah, I mean, I've seen founder as product manager as an interesting place for them to need to let go. Often these companies are started by someone who's an expert in an area. They're a subject matter expert in real terms, and they seem to want to remain in control of the product while the company's growing up around them. And they sort of lose a little touch with what the founding idea was, and they end up becoming a problem in the product. They're not as aware of the day-to-day operational concerns, though they think they are, because that can change over time. To get to $8 million in revenue, that might have taken you 5 years. You can be that much removed from the day-to-day life of the people and their problems they're trying to solve.
Yeah. The other thing that's true for founders is like, it just sort of obvious, but being a founder doesn't necessarily have to mean being a CEO. And not all founders are great CEOs. It's a very different skill set. Founders are idea people. That's why we're called 82 Ideas. And they're not necessarily great general managers. And so Some founders may reach the point where they say, you know what, it's going to be best for this business if I step away from the CEO realm. And, in the case you just mentioned, like maybe then they should be the product manager or they should be the CPO or the visionary or whatever it is. But if they try to do both, they aren't able to do either very well. Being a CEO and a general manager is a full-time job, and being a good product manager is a full-time job. And you really sort of have to be selective about where you are able to be most effective.
That's great. One last question, my new favorite question. Jason, looking back over the last couple of years, if you could do anything differently for you or with your clients, what would that have been and why?
Yeah, and you said you're going to ask this question, and it got me thinking, because my first instinct was I've been at 82i for 2 years, and I don't think I've changed a thing. I think like the entrepreneurial process is necessarily and naturally twisted. There's mistakes we made along the way, but we learned from them and iterated and got to where we are today. And I think in entrepreneurship, as long as you just keep doing that, you stay persistent, you keep solving problem after problem after problem, you'll be successful. And so what I came to was honestly, I should have started this sooner because I'm having so much fun being an entrepreneur. I'm really enjoying the whole process. And so if anybody's thinking about it, it's the best thing you can do. It's the most fun and you won't regret it. And I certainly haven't. So yeah, that's my answer.
There you go. Well, thanks so much, Jason Shapiro. Really enjoyed speaking with you and learning more about 82i. If people want to reach out to you, how can they do that?
My email is jason@82i.com. That's EIGHTY, the number 2, the letter I.com. And I look forward to talking to you. Happy to help any founders that I can.
Awesome. I'm on LinkedIn at LinkedIn/in/Ken Lempit. My company's Austin Lawrence. And if you haven't subscribed to the podcast yet, please do so wherever podcasts are distributed. Jason, thanks again for a great episode.
Thanks, Ken.
Thanks for listening to the SaaS Backwards podcast, brought to you by Austin Lawrence Group. We're a growth marketing agency that helps SaaS firms reduce churn, accelerate sales, and generate demand. Learn more about us at www.austinlawrence.com. You can email Ken Lempit at kl@austinlawrence.com about any SaaS marketing or customer retention subject. We hope you'll subscribe, and thanks again for listening.